Ever wonder how the rich continue to increase their wealth passively even while they sleep? Shockingly enough, you can do it too. In today's video, we're going to explore the art of making money online by investing in dividend-paying stocks. We'll delve into the steps one ought to take, the financial planning involved, and the potential pitfalls to avoid. But remember, we're only scratching the surface here. There's a world of detail and strategy waiting for us. So, why should you join us on this deep dive into dividend investing? It's simple. By the end of this video, not only will you grasp the basic principles of dividend investments, but you'll also have a clear understanding of its potential as an additional income stream. Stay tuned till the end because we have a pro tip that could give your investments a significant boost. Identify your investment budget. Identifying your investment budget is one of the most integral components of sound financial planning and wealth building. It involves setting aside a proportion of your income that you can use for investing in asset categories like equities, bonds, real estate, mutual funds, or any type of investment vehicle. This budget can contribute to creating a comprehensive financial portfolio and potentially paving the way for long-term financial stability and growth. Here are some important factors to consider while identifying your investment budget. Assessing your financial situation before you determine your investment budget. Be clear about your current financial standing. Know your income, expenses, liabilities, and savings. This will provide you a realistic picture of your monetary health. Setting your financial goals, whether you're investing for retirement, your child's education, a new home, or any other financial goal. Quantify the amount in monetary terms and the period in which you wish to achieve these goals. Analyzing your risk appetite. Investments invariably deal with a certain degree of risk. While equities may have high returns, they also carry high risks. Conversely, bonds or fixed income instruments carry lower risks but also offer lower returns. Identify your risk-taking ability to decide on your investment vehicles. Building an emergency fund before you begin investing. It's important to set aside 3 to 6 months' worth of living expenses. This fund can act as a safety net for unforeseen circumstances, thereby not forcing you to withdraw from your investments prematurely. Regular review. Your financial situation, goals, and risk appetite are not set in stone. These factors can change over your lifetime. Hence, it's necessary to regularly review and adjust your investment budget accordingly. Seeking professional assistance. If you lack financial knowledge, you can consult with a financial advisor. They can provide you with an investment strategy that aligns with your financial goals and risk tolerance level. These professionals can also guide you in creating and managing your investment budget. Remember, the primary goal of an investment budget is to ensure that you're using your disposable income wisely and contributing regularly to your long-term financial goals. It's not about investing as much as possible, but rather investing wisely and consistently. Research and learn about dividend-paying stocks. Investing in dividend-paying stocks is a multifaceted strategy that provides not only a potential for capital appreciation, i.e., a rise in stock price, but also a regular source of income from the dividends paid out by the company. Research is a crucial step in determining which dividend-paying stocks are worth the investment. When researching dividend-paying stocks, investors look at several key metrics and indicators to decide whether a particular stock is a viable investment option. Dividend yield. This is a financial ratio that shows how much a company pays out in dividends each year compared to its stock price. The dividend yield is an accurate representation of the real return that will accrue to the investor should she invest in stock. Dividend payout ratio. This is a measure of the percentage of the company's earnings that are given out as dividends. A low payout ratio could indicate that the company is reinvesting its earnings into further growth, while a high ratio might mean the company is not growing and is returning most of its earnings to shareholders. Dividend growth rate. This is particularly important for investors who use a buy and hold strategy. A company that has a record of consistent dividend growth makes for a more attractive investment as it signifies financial stability and reliability. Company's financial health. Before making an investment, it is crucial to analyze the company's fundamentals and overall financial health. Look at the income statement, balance sheet, and cash flow statement. A company in a healthy financial position is more likely to have a stable and growing dividend. Industry trends. It's also important to evaluate the overall health of the industry in which the company operates. Industries going through a significant downturn may result in dividends being cut. Dividend coverage ratio. This ratio indicates how many times a company can pay dividends to shareholders out of its net income. A higher coverage ratio signifies a more sustainable dividend. Investing in dividend-paying stocks can be a rewarding way to grow wealth over time. However, like any investment, it does involve risk. Investors should conduct thorough research and consider seeking advice from financial advisors before making any investment decisions. Start investing in a broad market index fund. Index funds are known for providing broad market exposure, low operating expenses, and low portfolio turnover. These funds adhere to specific standards or indices like the S&P 500 or the Dow Jones Industrial Average, DJIA, to guide in structuring and balancing their investment portfolios. Beginning your investment journey in a broad market index fund can present an array of advantages. Here are a few reasons why you may want to get started. Diversification. These funds consist of investments from diverse sectors, reducing your exposure to any single company's financial condition. If one sector or company is performing poorly, they're unlikely to grossly impact the entire investment. This makes index funds more stable. Lower costs. Index funds are passively managed, meaning they aim only to track the performance of the index. This results in lower management fees compared to actively managed funds. Over time, these lower fees can lead to significant savings. Transparency. Index funds are clear about their holdings because they track a predefined index. Accessibility. Even if you are a beginner, investing in index funds is user-friendly, as it doesn't require advanced knowledge of the stock market. Despite the benefits, investing in broad market index funds also carries some risk. Market crashes. Because of their nature, when the market goes down, so does your portfolio. Investing in an index means you are subject to market volatility. Limited potential of high returns. Passive management restricts your fund's ability to potentially outperform the market. While you'll likely mirror market returns, you'll also miss out on the rewards of hand-picked stocks. Lack of control. You don't get to decide which companies make it into the index, and thus have limited control over your investments. Before you start investing in a broad market index fund, here are some steps to consider. Assess your financial goals and risk tolerance. Define your investment objectives. Are you saving for a home, retirement, or financial security? Evaluate your risk tolerance. Can you handle the market's ups and downs? Research and choose the right fund. Look at fund performance history, the index it tracks, management fees, and minimum investment requirements. Start investing. You can usually buy index funds directly from a mutual fund company or a brokerage. Continually monitor your investments. Always keep an eye on your investments to ensure they continue to align with your financial goals. Remember, investing always carries risks. Therefore, take the time to fully understand what type of investment best suits your needs, and if necessary, consult a financial advisor. Narrow down potential dividend stocks to invest in. Investing in dividend stocks can provide a solid stream of passive income and contribute significantly to your overall return from stock investments. However, not all dividend stocks are the same. Some may offer high yields but might be risky, while others may provide a steady stream of income over time. Therefore, it's essential to know how to narrow down potential dividend stocks to invest in. Here, several tips are given that can help you make the right choice. Evaluate dividend yield. This ratio refers to a financial ratio that shows how much a company returns in dividends each year relative to its stock price. A higher dividend yield can seem attractive but may also indicate that the company is facing troubles. Therefore, consider a company's dividend yield in the context of its industry to ensure it is both attractive and sustainable. Check dividend growth rate. A company with a steady dividend growth rate is a good indicator of its strong financial health. It also signifies that the company is likely to continue increasing dividends in the future. Look at the payout ratio. The dividend payout ratio refers to the percentage of earnings a company pays to its stockholders in dividends. A low payout ratio can be a good sign as it means the company has ample room to grow its dividends in the future. Review the company's financial health. A company with strong financial health is more likely to pay dividends consistently and possibly even increase them over time. Key financial metrics to review include revenue, earnings, debt, and cash flow. Consider the company's history of dividend payments. Companies that have a long history of paying dividends are often more reliable than those who have just started to pay out. Invest in different sectors. To ensure a diversified portfolio, consider dividend stocks from different sectors. If one sector experiences a downturn, your portfolio won't be severely affected. Keep long-term perspective. Investing in dividend stocks is typically a long-term strategy. Look for companies that have the potential to maintain and increase their dividend over time. Regular monitoring. The work doesn't stop at buying dividend stocks. Make sure to regularly monitor your investments. Company situations can change quickly, impacting their ability to pay dividends. It's also important to consult with a financial advisor or conduct extensive research before making any investment decisions. The tips mentioned aim to narrow down potential dividend stocks, but it's necessary to consider your financial goals, risk tolerance, and investment horizon. Analyze the financial health of potential investments. Analyzing the financial health of potential investments is a critical step in the responsible and effective management of assets. The said process involves evaluating various financial data, including current and long-term liabilities, profit margins, revenue growth, and cash flows. This analysis is crucial for determining the potential return on investment and the level of risk associated with a specific investment. Key elements to analyze: assets and liabilities. Analyzing the assets and liabilities of a company provides a clear indication of its financial stability. An organization whose assets surpass its liabilities is in a healthier financial position than a company with more liabilities than assets. Financial statements. Various financial statements, including balance sheets, income statements, and cash flow statements, offer invaluable insights into the financial health of potential investments. These offer a comprehensive view of a company's operations, financial stability, profitability, and cash flows. Profit margins. Profit margins represent the percentage of revenue that a company retains as profit after accounting for various costs. A company with a high profit margin is generally considered more secure as an investment than a business with a low profit margin. Revenue growth. Consistent and significant revenue growth usually means that a company is expanding its market share and is in a stable financial condition. This could signify a worthy investment. Debt-equity ratio. This is a financial ratio indicating the relative proportion of shareholders' equity and debt used to finance a company's assets. A high debt-equity ratio may mean that the company has been aggressive in financing its growth with debt. This can result in volatile earnings. Cash flow statement. This statement provides data regarding a company's cash generation capability. An investment prospect might be considered attractive if the company generates a significant amount of cash from its operations. Market competition. The competitive position of a company can significantly impact its financial health. Therefore, it's crucial to analyze the competitiveness of the market in which the company operates. When analyzing the financial health of potential investments, investors should consider all these factors collectively rather than individually. This holistic approach can provide a more accurate picture of a company's overall financial health and the potential return on investment. Note that investing always bears a certain level of risk. Therefore, it's important to consult with a financial advisor or perform extensive research before making investment decisions. Check the company's dividend payout history. Analyzing a company's dividend payout history is an essential aspect when it comes to making investment decisions. Generally, investors seeking regular income prefer companies with a consistent track record of paying dividends, as it reflects the company's financial health and profitability. The dividend payout history provides insights into the frequency and amounts of dividends paid out to shareholders over time. It allows investors to forecast potential future dividends, analyze the stability and growth of dividends, and understand the company's capital allocation strategy. Here's how you can go about checking a company's dividend history. Corporate website. One of the quickest ways to access a company's dividend history is by visiting the company's official website. Most companies dedicate a section of their websites to investor relations where they provide information about earnings, dividends, annual reports, and more. Financial news websites. Websites like Yahoo Finance, Google Finance, Bloomberg, and others provide comprehensive information about companies, including their dividend history. Stock exchanges. Stock exchanges such as the NYSE, NASDAQ, LSE, etc., provide detailed information about listed companies. This information includes dividend history, which you can review before investing in a particular company. When analyzing a company's dividend payout history, consider the following factors. Consistency. Consistency in paying dividends is generally seen as a sign of a company's good financial health. Regular and steadily increasing dividends indicate the company's robust business model and high profitability. Dividend yield. This ratio shows how much a company returns to its shareholders in the form of dividends. A higher dividend yield could indicate an undervalued company, while a low yield may suggest overvaluation. Dividend coverage ratio. This ratio indicates how well a company's earnings can cover its dividend payments. A high coverage ratio suggests that the company can comfortably pay out dividends. Retained earnings. A company that retains a good amount of its earnings for growth and expansion but still pays regular dividends indicates a well-balanced approach towards shareholder returns and future growth. Remember, while high dividends can be attractive, they should never be the sole factor for making investment decisions. It's essential to look at other company performance indicators, as a financially unstable company may also pay high dividends to attract unwary investors. Be sure to conduct a thorough financial analysis or consult with a financial advisor before making any investment decisions. Choose the best time to buy the stocks. Choosing the best time to buy stocks is pivotal in maximizing your returns in investments. The ideal time to buy stocks is one of the most debated topics among investors and analysts. However, it ultimately depends on the market conditions, your financial goals, your risk tolerance, and economic factors. Nevertheless, a general rule of thumb that echoes amongst many investment gurus is, buy low, sell high. Understand the market conditions. Becoming an enthusiast of different stock markets can provide you profound insights into when might be a suitable time to buy stocks. For instance, a bear market, when prices are falling, and investor confidence is low, could be the ideal time to buy stocks at a lower price. On the other hand, during a bull market, when prices are soaring and investor confidence is high, it's crucial to be more cautious not to buy stocks at inflated prices. Monitor economic factors and indicators. Economic health plays a crucial role in the performance of stocks. Things like the unemployment rate, consumer price index, gross domestic product, retail sales data, inflation rates, and the performance of different sectors influence market behavior. Therefore, staying up to date with these indicators can help forecast potential fluctuations. Fundamental analysis. This method involves evaluating a company's financial health, competition, and overall industry landscape. It's an ideal strategy to identify long-term investment opportunities. If a company shows strong financial performance and growth, it might be a good time to buy its stocks. Follow market trends. Look at the historical performance of a particular stock. If it typically increases during a certain period of year, planning your investment around that time frame could be beneficial. Use limit orders. It's a condition set on an order that restricts the maximum price to be paid or minimum price to be received. Using this will help to avoid paying more than you want for a stock, especially during a volatile market. Consider dollar cost averaging. This investment strategy involves purchasing a fixed dollar amount of a particular investment on a regular schedule, regardless of the share price. As a result, more shares are purchased when prices are lower, and fewer shares are bought when prices are higher. Get professional advice. Financial advisors can provide personalized insights and strategies based on your financial status and goals. They keep a constant eye on the market, helping you buy stocks at the most opportune time. Remember, while timing the market might be tempting, a more reliable way to enjoy good returns is by buying quality stocks and holding onto them for extended periods. Warren Buffett's approach is to buy solid stocks and then patiently wait, disregarding the day-to-day fluctuations of the stock market. Set up a brokerage account. Setting up a brokerage account is a crucial step for individuals wishing to start investing in stocks, bonds, mutual funds, and other types of securities. Brokerage accounts serve as a means for investors to deposit funds and make investments within the market. Here is a detailed guide on setting up a brokerage account. Choose a brokerage firm. Deciding on which brokerage firm to open an account with is the first step. You will need to consider things such as trading fees, credibility of the institution, the minimum amount required to open an account, customer service, the types of investments they deal with, etc. There are two types of brokerages, full service and discount. Fill out the application form. Once you have chosen a brokerage, you will then need to fill out the application form. This is usually done online and includes providing personal details such as name, address, social security number, and employment information. Understand your investment goals and risk tolerance. It's vital to have clear investment goals and a risk tolerance defined. This will help you decide the right kind of brokerage account, like cash account, basic account, margin account, loan, additional funds for investment, etc. Deposit funds. After your application has been accepted, it's time to deposit funds into the account. This can typically be done via a direct bank deposit, wire transfer, or check. Set up your portfolio. Once your account is set up and funded, it's time to start building your investment portfolio. This step may require some research and planning, especially if you're new to investing. Make sure to diversify your portfolio. Start trading. Now that everything else is done, you can start placing orders to buy and sell securities. Monitor your investments. After investments are made, you will want to monitor them to see how they are performing. This could also involve periodically rebalancing your portfolio to ensure it still aligns with your goals. Remember, when you set up a brokerage account, it's likely that you will be asked to decide between a cash account and a margin account. A cash account requires you to pay full price for any investment purchases, while a margin account allows you to borrow money from the broker to purchase securities. Also, understanding the user interface, order options, and other tools provided by the brokerage platform is also important in optimizing your trading activities. Most brokerage firms offer a range of tools and resources to help investors make informed decisions and know the risk involved. Lastly, when you open a brokerage account, you must be aware about the rules regarding taxes. In most cases, you will be liable to pay taxes on any profits made from selling investments at a higher price than what was paid. Always remember, investing involves risk, including the risk of loss. Before making investment decisions, it's suggested that you seek guidance from financial professionals. Buy the dividend-paying stocks. Investing in dividend-paying stocks can be a valuable part of a well-rounded investment strategy. Dividends are regular payments made by corporations to their shareholders, typically on a quarterly basis, drawn from their post-tax profits. These stocks often represent mature, profitable companies that have a sustainable competitive advantage in their respective industries. There are several reasons why investors should consider buying dividend-paying stocks. Consistent income. Dividend-paying stocks provide regular income to shareholders, which can be very attractive, particularly to income-focused investors such as retirees. This is in addition to any potential capital gains from the appreciation of the stock price. Reduced risk. Companies that consistently pay dividends are typically the ones that are financially stable and have predictable cash flows. As such, investing in these types of companies reduces the risk of financial loss in case the market goes down. Reinvestment opportunities. Dividends provide a significant source of income that investors can choose to reinvest. Compounded over time, reinvesting dividends can significantly increase the growth rate of an investment portfolio. Defensive investment. During volatile market conditions, dividend-paying stocks typically perform better than non-dividend-paying stocks. This is because dividends provide a steady income stream that helps to buffer stock price fluctuations. Indication of financial health. A consistent dividend payout is often an indication of a company's financial health. It shows that the company is generating enough profits to reward its shareholders and potentially indicates that its business model is working well. However, before investing in dividend-paying stocks, investors should also consider factors such as the company's payout ratio, dividend yield, and whether the dividends have been growing over time. These metrics can help ensure that dividends are sustainable and that the company is not returning money to shareholders at the expense of its own growth. In conclusion, buying dividend-paying stocks can provide various advantages, including regular income, lower risk, and compounding growth from reinvested dividends. Nonetheless, thorough research and due diligence should be carried out before investing in these stocks to understand the company's financial health and the sustainability of its dividend payments. Reinvest the dividends. Reinvesting the dividends is a strategy often used by investors to fuel the growth of their investment portfolio. Dividends are a portion of a business's earnings that are paid out to shareholders as a token of appreciation for their investment. Instead of taking these dividends as cash, investors have the option to plow it back into purchasing additional shares of the business or other investment ventures. Reinvested dividends result in compound interest, as shareholders earn dividends on their additional shares in subsequent years, accelerating the growth rate of their initial investment. This can significantly increase the investor's wealth over the long term, especially in a stable and growing company. Moreover, several businesses offer their shareholders dividend reinvestment programs, DRIPs. DRIPs provide the advantage of acquiring additional shares directly from the company without the involvement of a brokerage firm, often at a lower cost. DRIPs may also allow investors to purchase fractional shares, which means every penny of the dividend is working for the investor. However, the caveat of reinvesting dividends is the added impact on tax. Depending on the jurisdiction, the dividends might be subject to tax even if reinvested, and the shares purchased with these dividends could bring in additional capital gains tax when sold. In conclusion, Reinvesting dividends can be an efficient strategy to maximize the returns on your investment if done wisely and in alignment with one's financial goals. It's always recommended to consult with a professional financial advisor to understand tax implications and invest effectively. Monitor your stocks regularly. Monitoring your stocks regularly is an essential activity for every investor, irrespective of their involvement in the stock market or the volume of their investments. Keep in mind that regular monitoring doesn't mean daily checking, as it can also lead to impulsive decisions. Instead, develop a routine based on your investment strategy and follow it. Understand your investment. Knowing the specifics of the company you've invested in is crucial. Follow news updates, keep track of management discussions, quarterly and annual reports. This information is pivotal in understanding the organization's financial health and future prospects. Keep up with market news. Stock prices react to political, economic, social, and industrial news. Changes in government policies or worldwide events significantly affect the market. Hence, following reliable financial news sources can provide critical insights into the possible impacts on your investments. Stay updated on financial performance. Regularly check the financial performance of your stocks through the company's balance sheet, income statement, and cash flow statement. These documents help you understand the company's profitability, operational efficiency, liquid assets, and debt situation, which directly reflects on the stock price. Track stock prices. Use financial tools and applications to track stock prices. Observe the trend over a while, either weekly or monthly, as everyday prices can fluctuate dramatically and might induce panic. Review your investment strategy. Your investment strategy should be flexible to accommodate the dynamic market situation. Monitor how your stocks are performing against your strategy. Diversification review. If a portion of your portfolio doesn't perform well, other stocks can compensate for the loss. Regular monitoring ensures the balanced allocation of stocks across sectors, reducing the risk. In summary, monitoring your stocks is not about checking prices constantly. It's about staying informed about company performance, market news, reassessing your investment strategy, and making appropriate decisions when necessary. It also helps to understand when to stay patient during market volatility and avoid investing based on speculations or market gossips. Remember, informed decision-making, backed by research and disciplined approach, goes a long way in successful stock investing. Balance your investment portfolio. Balancing your investment portfolio is an essential step towards achieving your financial goals. The process involves allocating your investments among different asset classes such as stocks, bonds, real estate, and cash equivalents. The primary purpose is to optimize returns and minimize risk. Balancing a portfolio requires careful analysis and decision-making skills. It's about managing and diversifying your investments to take advantage of market opportunities while limiting potential losses. It isn't about always making the highest returns, but about focusing more on meeting personal financial objectives and controlling risk. Additionally, your portfolio balancing must consider your risk tolerance, investment horizon, and financial goal. Your risk tolerance determines how much risk you're comfortable taking in exchange for the potential of higher returns. For example, if you're risk-averse, you may structure your portfolio to include more highly rated corporate and government bonds, which are generally considered less risky than equities. Your investment horizon, the estimated number of months, years, or decades you will be investing to achieve a particular financial goal, also plays a key role in balancing your portfolio. For instance, younger investors typically have a longer investment horizon and may feel comfortable taking on more risk for the potential of greater returns. Balancing your investment portfolio also requires regular reviews and adjustments as market conditions, your lifestyle, and financial objectives change. This process is known as rebalancing. Essentially, when some investments are performing well and others aren't, rebalancing involves selling some of the high performers and buying more of the low performers to maintain your original asset allocation. By effectively balancing your investment portfolio, you reduce the chance of being overly exposed to a single asset class and its inherent risks. For example, if your portfolio is heavy on stocks and the stock market crashes, you could suffer severe losses. However, if your portfolio is well diversified and balanced across different asset classes such as stocks, bonds, and real estate, a downturn in one won't be as painful. In conclusion, balancing your investment portfolio is crucial for long-term financial success. It requires strategic allocation, regular monitoring, and adjustments of your investments to accommodate your changing needs and market conditions. Engage a financial advisor if you need help setting up a well-balanced investment portfolio. Keep track of your investments' performance. Keeping track of your investments' performance is a crucial part of successful investing. This allows you to assess how your investments are doing over time, identify any potential issues, and make necessary adjustments to align with your financial goals. There are several ways to monitor your investments' performance. These might include periodic reviews of financial statements, frequent check-ins on your portfolio balance, researching financial news related to your investments, and even utilizing financial tech tools or apps that automatically track, analyze, and present your investment data. Why is it important to do so? Measure performance. Tracking helps you to see how your investments are doing in terms of returns. Understanding this can help you to adjust your strategy. Gauge progress against goals. If you've set financial goals, tracking allows you to see how your investments are helping you reach these goals. If you're falling short, it might be necessary to adjust your investments or savings rate. Identify necessary changes. Regular tracking can highlight when changes might be needed. For instance, perhaps one area of your portfolio is performing poorly consistently. This insight allows you to make informed decisions. Avoid financial mistakes. More frequent check-ins can help you avoid major pitfalls, while mitigating potential losses. Peace of mind. Regular tracking helps you stay on top of your investment and can provide peace of mind when it comes to your financial future. To go about it, consider creating a systematic tracking schedule. This might mean weekly check-ins, or it might mean monthly or quarterly reviews. The frequency will depend on the nature of your investment and personal preference. Also, use trusted sources to gather information about your investments and market conditions. Remember that investing is a long-term endeavor, so avoid reacting impulsively to short-term market fluctuations. Instead, keep your financial goals in sight and stick to your investment plan, adjusting as necessary based on considered tracking insights. Finally, consider seeking professional advice if you're unsure. Investment advisors can provide valuable assistance in tracking your investments and keeping your financial plan on the right path. Sell the stocks if it is not performing as expected. Selling stocks that are not performing as expected can be a strategic move to protect your investment and free up capital for other investments. No matter how carefully you researched and bought the stocks, you cannot control every single factor that affects their performance. An unexpected incident, such as a change in the market condition, a global economic crisis, new government regulations, a scandal involving the company, a sudden drop in earnings, etc., can all cause the stocks you own to underperform. By selling underperforming stocks, you cut your losses short, and this can often be better than holding on and hoping for a turnaround. The money you get from selling can then be reinvested in a different stock or sector, potentially yielding higher returns. It's also a good way to diversify your portfolio if it's currently overweight in a sector or stock that's doing poorly. However, determining when to sell a stock is not so straightforward. Before selling, investigate why the stock is underperforming. Sometimes, it could be due to a short-term problem. The company might rebound and outperform in the future. Also, selling might lead to tax implications which also need to be considered. Furthermore, it is crucial to ensure that your decision to sell is not driven by emotions. Panic selling, due to market corrections or temporary setbacks, can lock in losses and prevent you from benefiting from potential upswings. Keep track of the company's performance and measure it against your investment goals. If possible, seek advice from professional financial advisors who can guide you about the timing and implications of selling your stocks. In essence, selling stocks that are not performing well is one way to manage risk in your investment portfolio. However, it requires careful consideration of many factors. The key is to make sure that every investment decision aligns with your overall investment strategy and long-term financial goals. Pay taxes on the dividends received. Dividends are financial rewards paid out by corporations to their shareholders, typically in the form of cash or additional shares of stock. When a shareholder receives dividends, they are generally subject to taxation. This applies to both dividends received from shares owned in individual companies or those collected from mutual funds. The amount of tax you would have to pay on your dividends depends on a number of factors, such as the jurisdiction you reside in, the specific tax laws in that area, and the type of dividends received. In the U.S., for instance, dividends are classified into either qualified dividends or non-qualified dividends. Qualified dividends are those that meet special requirements set by the IRS and may include dividends paid by U.S. or certain foreign corporations, given that the shares are held for over 60 days during a 121-day period that starts 60 days before the ex-dividend date. Non-qualified dividends do not meet these requirements. The tax rate applied on qualified dividends is more favorable and ranges from 0-20% depending on the taxpayer's taxable income and filing status. Non-qualified dividends, on the other hand, are taxed at the shareholder's individual income tax rate. It's also noteworthy that dividends received may need to be reported when filing your income tax return, even if they are not taxable or have already been taxed at source. This is the case in countries like the UK, Canada, and Australia. In some jurisdictions, there is a minimum threshold for dividend income, below which the recipient needn't pay taxes. Certain retirement accounts may also offer protection against dividend taxes. Bear in mind that tax laws can be complex and vary widely, so it's always advisable for shareholders to consult a tax advisor or accountant in order to understand the specific implications of dividend taxation for their situation. In conclusion, paying taxes on dividends received is a common obligation for most shareholders. It is therefore important to plan for this to avoid unexpected tax bills and potential penalties. A deeper understanding of the specifics of dividend taxation in one's jurisdiction and financial situation enables smarter decision-making around receiving dividends and managing tax obligations. And that's a wrap for today, folks. We hope you found value in this video. If you've enjoyed the content we presented today, don't forget to hit that big red subscribe button down below for more. Every click supports us in creating more high-quality content tailored just for you. Press that like button if you found this information relevant and useful. We love hearing from you, so don't hesitate to leave your thoughts, experiences, or questions in the comment section, no matter how outlandish they might seem. Also, don't miss out on any of our awesome content by clicking on the bell symbol. That little guy ensures that you're with us every step of the way, keeping you up to date with all our latest content. If you loved this video, chances are you'll find our videos exciting and informative. A link to it should be appearing on your screen right about now. Thanks for being such an integral part of our community, and who knows? Maybe next time we'll be tapping into your experiences for our video content. Can't wait to see you there. Stay curious.